Welcome back to All Things Money. I'm David Blain, and during this segment we're going to talk a little bit about taxes. But before we do, last week there were some important things in the bond market that happened. Moody's, the credit rating agency, warned that the U.S. may lose its AAA credit rating. And of course this would be an absolute disaster if it happens. I don't know that it will, but Treasury Secretary Geithner vehemently denied this would happen because investors still view the dollar as the safe haven during economic crisis. Incidentally, PIMCO, who's the world's largest bond manager, last week their chairman and CEO was talking about how they are going to be moving into German bonds and a little bit away from the U.S. Treasury. The reason that they're doing this is they feel that German bonds may offer a better value over U.S. Treasuries in the time period to come. And what we see, this brings up kind of a larger point of investing in foreign bonds. Does it make sense to invest in foreign bonds? At our firm, we believe that yes, it does. Over time, help with the return of the portfolio to invest in foreign bonds. One of the things you see when investing in German bonds or Euro bonds or British bonds or Japanese bonds is that a lot of the return to foreign bonds when you're a U.S.-based investor is actually a result of currency fluctuations. There's something in the world called interest rate parity theorem that says that based on growth rates and inflation rates in the different countries around the world, that actually all the interest rates are equal when you take into account the fluctuations and differences in the currency. It's called the interest rate parity theory. Well, we still believe if we look at some studies, this data from 25-year periods from 97 through 2005, we see that adding foreign bonds to U.S. portfolio in any percentage from 10 to 30% led to better risk-adjusted returns. Not necessarily better absolute returns in every period, but certainly on a risk-adjusted basis, the addition of foreign bonds has been able to level the volatility of the portfolio out. Many years it did increase the return, but certainly across all time periods of the study that I mentioned, the addition of between 10 and 30% foreign bonds to the portfolio lowered the overall volatility. So we like to see a little bit of foreign bonds in the portfolio. This year there's two big things that are happening out there in the tax arena. The ability to convert a Roth IRA to a traditional IRA, as well as the potential repeal of the estate tax. And we're going to spend a little bit of time on that. But first I wanted to touch on President Obama's new budget. He came out with a new budget last week that makes several changes to the tax law. A couple of things: the two top income tax rates will return to 36 and 39.6%. And I just wanted to point out that so if you pay 36% federal tax and you live in North Carolina, you're going to pay, we'll just round it off to another 7% state income tax. So that's 43% tax right there. If you work someplace, don't forget you have Social Security and Medicare, and so that's 7.65%. So if you are in the highest federal bracket, you're going to, or the second highest, 36% federal, 7% state, that's 43, plus another 7% Social Security and Medicare tax. Congratulations, you're now paying 50% of your income to taxes. And you haven't bought anything yet. If you go to the store and actually would like to purchase something, now you're going to pay another roughly 7% sales tax. So now you're up to 57% of your income that it took to buy one thing. I just don't see how continually raising taxes is a good thing for our economy. For people, most of President Obama's proposal discriminate against people making over $200,000 a year or $250,000 a year for couples. The capital gains and dividend rate would be raised from 20% to 20% from 15%. He's proposing capping itemized deductions, capping the deduction at 28%. He's also proposed reinstating the estate tax, which was repealed. It would come back in at 45%, although there would be a $3.5 million exemption, and it would make these rates permanent. And so what that means is if your estate was less than $3.5 million, there would be no estate tax and you wouldn't have to worry about it. He also proposed putting limits on the use of family trusts. It's a very common technique to minimize someone's estate taxes to use a family trust. He dropped a request to make permanent the whopping $400 tax credit that you may or may not have known that you got last year. He did propose that it's extended through the year 2012 as opposed to making it permanent. He would extend the Bush tax cuts for people in the lower tax brackets, and so that's good to hear, keeping the 15% rate on capital gains and dividends as well as the lower taxes. But the bottom line is by raising the taxes on a lot of the people that make money and frankly own the businesses and drive a lot of the jobs, it is not going to be good for creating more jobs and moving the economy forward. Just like the bank tax, if anyone out there thinks that adding a tax to the banks is not going to be passed on to consumers, well, I don't know who you think is going to pay for that, but the banks are just going to turn around and pass it right on to you and I. So that brings us to our final break. When we come back, we'll answer a few questions about converting a regular IRA to a Roth IRA. So for All Things Money, I'm David Blain, and we'll see you after the break.